Okay, so our discussion today is about minimizing lifetime taxes. And so, we're going to be taking about an hour as we go through this information. Please, if you have some questions, something's not clear, we've got a small group, certainly can entertain more, so you can kind of just speak up if that's okay. And as we go, I won't ask you to raise your hand or anything along that line. So again, the idea of minimizing lifetime taxes is certainly a worthy goal. Taxes, as you'll see in a number of ways, can slowly just erode the amount of money that we can accumulate, the amount of money that we can enjoy over our lifetime. And, in all of the massive pages of the tax code, some of the taxes that we pay are voluntary in essence, that they can be not evaded, that's illegal, but they can be avoided, they can be minimized just by being strategic about certain things, by knowing what tools, what strategies are available in order for us to minimize the entire tax bite, and especially over a lifetime. So there's certain things and structures that often people will go through to minimize their taxes just for this year. But what they don't necessarily realize is how that might be positioning them for future years. And sometimes the tax bite today on a strategy doesn't look too big, but then when you examine it and say, well, is that a course of action I would want to continue? And what does 5, 10, 20, 30 years look like in that situation? What will that do for us as far as taxes go? So this information is good. It's a good background. It's going to be kind of like Minimize Lifetime Taxes 101. Some very important aspects to get the whole context, to get the players, like if you were playing chess, this is how different pieces kind of move and how they work. And so look forward to getting your thoughts as we continue to move through with it. So the first thing that we're going to spend some time on here is just looking at the history of taxes. It's very interesting that as we go through the tax code, is that taxes really didn't begin until like 1913. So you think about that. Prior to that, taxes were illegal. Income taxes were illegal. It's amazing. So they had to pass a constitutional amendment in order for income taxes to actually be assessed. And at the time, what you can see is when taxes were first introduced back here, like in 1913, the top tax bracket was 7%. And it stayed that way. And actually, it was considered to be a temporary tax. What they didn't know when they instituted it, that World War I was going to happen. And a lot of expenditures went up. And so very shortly, by 1917, the highest marginal tax rate went from 7% up to 67%. And the lowest bracket had gone up to 6% from 1%. So just a dramatic increase in the income tax load. Well, what happened then after that was the Roaring 20s, after World War I was occurred, and they got tax brackets again down so that the highest rate was again just 25%, and the lowest bracket was in the ones again. So most of us wouldn't be too bad if we got a $100,000 check and we had to pay $1,000 in tax. That would have been pretty good at that time versus earlier $67,000 in taxes. So then again, the 1920s, the Roaring 20s became the Depression years shortly after that, and all of the different public works programs, all the different massive increase in government, and so again, tax rates went way up until they were in the 70s, 80s, 90%. So imagine 90% of a check going to taxes. Now again, that wasn't something that the average person faced, but the lowest bracket at the time was 20. So you were going to pay somewhere between 20, and for the people, the highest earners were going to pay as much as 90%. That started to come down, as you can see, went down, and people probably felt a great deal of tax relief when a top bracket went from 90 to 70. And then it came down till then we had 28% for a few short years in the late 80s. And then that started going back up again. We had the 39.6 down to 35, up to 39, up here to 37 today. So as we look at that, and you think of the future, because we don't know the future is fundamentally unpredictable. It would have been probably hard for people to believe in these years that there would ever be a 37, 35, 28% bracket. But if you were to consider the future, do you think that taxes will probably be higher or lower? 10, 20 years. Sure. It looks like it very well go higher, right? Yeah. And though we can't absolutely predict, certainly we would want to be prepared so that, and not just have such tax rates go like, well, it'll always be this good. We don't know for sure, but we certainly don't know that it can't go back up. We know that there was congressional and administrative enough push to have things go up. There's been talk in this last year that rates could go as high, back up again. We don't know who it would apply to. We don't know what rates could be, but certainly there's a lot of economic pressures that could cause tax rates to increase. So it's just being prepared for those periods of time. So as we go through now too, we can think of, if someone had the opportunity to defer tax, that was a good move back here. When tax rates were 70%, when the top bracket was 50%, there were opportunities, and there were many, many different brackets at that point than exist today that go from 10 to 12 to 22, 24, 32, 35, 37 are the brackets today, that there were a lot more brackets. So your income could come down a little and you could pay a lot less in tax. So if you deferred income from a 70% tax bracket to a 50 or a 28 or even 35, you won the game. But it's a lot harder for tax deferral to necessarily work today because we don't know, now being in historically lower rates, that a deferral will actually work in our benefit. And so we have to just get the context of what we're doing. Now, what we want to look at here is the idea of how different things can be looked at as far as tax goes. So if we take a $100,000 single deposit, it could be that we could put money into that $100,000 into something that makes there's no tax on the gain, versus it's taxable every year on the gain, or where there is tax deferral. Okay, so what we're going to look at here, before I show that, I want to just skim here for a moment. Okay, so if we take non-taxable, what this assumes, this little calculator assumes, is that you put in 100,000, you had 30 years, then there was a 6% rate of return that you got over 30 years. How much would it grow? And that you were only in a 30% tax bracket. So what that would mean is that 100,000 could grow to 574,000 over 30 years. So almost 6 times as much money, $474,000 worth of earnings. And if it was tax-free, all of those earnings were yours. You got to keep the whole thing. Now, what we see is on a taxable or tax-deferred basis, if it was taxable, that means that $474,000 was taxable, which means you would have had to pay $142,000 in tax. Now, what you'll notice if you come over here to tax deferred, you would have paid $142,000 in tax. So if you look at a taxable account or a tax deferred account, did that change the amount of tax that you paid as you look at that? No. So why there's all this talk about deferring taxes and the benefit of tax deferral? Why would you not save taxes if you deferred the tax? Any idea? There's kind of a text question. Okay. It seems like I should be saving taxes if I'm deferring taxes. Okay. All right. So see if this makes sense here. Here's where the benefit of tax deferral can occur. So where can you earn tax deferred money instead of taxable money? Okay. Well, just a couple of examples. There are places where you can earn money tax deferred on both where the principal and the interest is tax deferred. But just to simplify this, we're going to assume that this blue is all after tax money. That $100,000 that was invested was all after tax money. So you made $100,000. Of course, on that $100,000, you pay no tax, right? It's only on the earnings that you pay tax. So here it was tax-free, no tax. Here the $100,000, the $474 now is what was taxable, and here it was tax deferred. So when you have to pay tax every year, what happens is you have another cost that you don't have when you have tax deferral. And that other cost is lost opportunity cost, or the time value of money. So just to explain here, that first year, and we'll see this in a moment, that first year you made 6% on $100,000. So that means you made $6,000. If you had to pay 30% of that in taxes, that means you would have had to pay $1,800 in tax that year, at the end of that very first year. When you had tax deferral, you didn't have to pay that $1,800 that year. You only had to pay it at the end. So think about, let's just say one person pays $1,800 in tax over here to the IRS. And then later that same day, after they stroke that $1,800 check to the IRS, a friend comes up to them and says, I'd like to borrow some money from you. I'm in need and I need to borrow it from you. And you say, okay, you can borrow it. And you say, but when can you pay me back? And they say, 30 years. That's a long-term loan, okay? So it's got to be a really, really good friend, okay? But now let's say you do that. And your friend borrowed the money for 30 years. In 30 years, he comes back to you and gives you your $1,800 back. Do you feel that you're even? Okay, why? You didn't charge any interest, right? You know you lost the time value of money. Had you not loaned it to them at zero interest, you would have had it invested and you could have made money on it, okay? That's how it would have happened if you loaned it. But now, the money you paid the IRS in year one, did you only lose the $1,800? Or did you, when you're looking at it from a 30-year perspective, did you also lose the earnings you could have made on that $1,800? So tax deferral means you don't lose the time value of money. You don't lose the opportunity cost. So when we put in a time value of money, let's say you could have made 6% on that money that you paid the IRS. Now those taxes that you paid, the same 142, but because you had to pay it out over time instead of at the end, it cost you $310,000. That's the lost wealth that you don't have on your balance sheet because both people have $574,000 in their account unless they took the tax out of the account. But if they had just stroked the $1,800 check and more, as we'll get into the next time, then they gave up both the tax and the lost opportunity, and that's $300,000 they don't have. Okay, whereas this person just has the 142 that they ended up having to pay at the end. Okay, make sense? Okay, and this is something that this concept, this understanding that when a dollar leaves our world, that over time it wasn't just the dollar, that piggybacking on that dollar, going for a ride was lost opportunity cost. And it never stops. Once that's gone, we lost that money forever and all the money that it could have ever made. So retaining dollars in our world is an important consideration. So when we're measuring one financial strategy versus another over time, it's critical that we understand the time value of money to balance things out. So we know one strategy is better than another one. Okay. Now over here on tax deferral, just as additional, so what kinds of things are taxable? So are non-taxable. Things that are non-taxable, for example, might be municipal bonds is a non-taxable item. A Roth IRA can be non-taxable. Cash values growing in a life insurance policy, I will get back to, can be non-taxable, okay, and tax-free also, all right, in how they're received. So those are items that could potentially have tax preference, and if things go right, and laws don't change or they're strategized correctly, you never would pay tax on that. Taxable items, such as this, could be things like money market accounts, CDs. Now, they're not making 6% anymore, but when I first learned this concept, they were making as much as 9%, 30 plus years ago. And so people were doing this and not knowing the impact of taxes on their life over time. Because you don't pay a lot of tax when you're making 0.25% on your money, right? But when you're making 4, 5, 6, 7, 8%, and we see interest rates are starting to move to a higher level than what we've had here just recently. So these things will become more important to know. But CDs, money market accounts, bonds, bond funds that are not municipal bonds would all fall into this taxable area if they're not in a retirement plan. Okay, but just of themselves, they have taxable. Tax deferred, in this sense, could be are certain types of annuities. So annuities not for income, but annuities for growth that are not in a retirement plan. They are in the tax deferred category. Some people they've maxed out the money they can put into an IRA on a pre-tax basis or a Roth IRA basis, and so what they can do is put money in on onto an IRA where they just get tax deferral on the earnings on that. So those are things that can be here in the tax deferral. Now, life insurance can either be here or it can be here. Okay, depends on how someone uses it. And then just as a little twist, you see here we have the red and we have the blue. Okay, so in this case, what happens is, and I like to think of this as beer. Okay, and so there's two ways that things can be tax deferred and then how taxes come out. One is it can be done on what's called a LIFO basis, LIFO, or a FIFO basis, FIFO. So last in, first out is how annuities, non-pre-tax IRAs, those are taxed on a LIFO basis, which means the first thing that went in was the $100,000 that you put in. The last thing that went in was the interest that was paid. So something that's taxed LIFO is, like I said, on the beer, if you pour a beer and you get the froth, think of the beer that you see at the bottom as what you put in. That's the first in. and think of the suds as the earnings. Okay? Well, LIFO means what comes out first is the suds. And so because the suds are coming out, you're getting taxed on the suds. Okay? The other, so that would be like, let's say all of this, let's just imagine for a moment that the red, it's not designed to illustrate what I'm showing you here, but imagine that the 100,000 was the red and the blue was the earnings. So here's the beer and here's the suds. This is LIFO. Until you take out all of the earnings, you're going to pay tax on everything you take out. And only till you get to the bottom are you going to be able to then not have to pay any tax. You have to get through all of the earnings first. You've got to get through the suds first. Okay. On the other hand, when it's considered on a FIFO basis, is in that case, imagine the principal or the beer is on top. And in that case, you get to take the principal out first before you ever take out the earnings or the suds. Okay? So FIFO tends to be more in most cases, and nothing is true in all cases, but in most cases, FIFO is preferable to LIFO. Okay? Because you can, at least from an immediate liquidity standpoint, you get to take that out first. Now, Roth IRAs can be non-taxable if you hold them and you handle things appropriately. If someone puts money into a Roth IRA and they're under 59.5, until they're 59.5, it works on a FIFO basis. If they take out money before 59.5, they get to take out what they contributed first, or the beer. And then if they take out more than they contributed, they're going to have to pay taxes, and they'll have to pay penalties if they're under 59.5. After 59.5, and after two rules, they have to be past 59.5, and they have to have a Roth IRA open for 5 years. It doesn't have to be that Roth, it just has to have a Roth IRA open in their world and for 5 years and past 59.5, then it's all comes out in the non-taxable world. Okay. Life insurance, for example, is a FIFO. So again, it's technically, so if someone put in their money into life insurance and they pulled the whole thing out, cashed their whole policy in, it would be would be taxed this way. But if they don't take all of it in, they don't cash it in, then what they're able to do is they're able to take out withdrawals on a first in, first out basis. The non-taxable comes out first. The law allows them to borrow against it once they take out all of the money that they put in and no tax. They're allowed to borrow against the earnings and then not pay tax. And then when the death benefit's paid, the whole thing gets paid out tax-free. So strategically, it can be in this bucket while you work and understand how the rules work. So you could, just like a Roth IRA could play in this bucket or in this bucket, life insurance can play in both buckets too. Depends on how you strategize around them, okay, on those areas. Okay? Where this comes into play is then in strategy. So now you have those ideas. Let's take a look at compound interest. Now, in the most part, in the past, have you heard that compound interest is good or bad? Okay, everybody has said that it's good. Okay, and that's what we're generally taught, because we want to have money grow and to be to make earnings on our earnings can be a positive thing. So what we talk here is that there's something called the rule of 72, and the rule of 72. Here's a thing: is how soon will this do? Now this only works not on money that's being added to an account every year, but money that's already in an account. So if I have $100,000 in the account and I want to know how soon it will double, what I do is I take the interest rate and divide it into 72. It's called the rule of 72. So what that means is for example, if I'm earning 6% on my money, I can divide 6 into 72 and I'll come up with 12. So that means in 12 years, my account will double. If I was earning 12%, it'll double in 6 years. So I can get pretty close. I can't divide 5% into 72, but I know I could divide 5 into 75, and that'd be 15. So I know it's a little less than 15 years that my account would double. Okay, so that tells us on that basis. But if we look at here and we take a look at compound interest for a moment, we're going to see something similar. We've got our 30-year study period, similar that we did before, 6%, just keeping everything the same so that you're able to see how this works. Again, I'm just going to show you the growth, and we'll see how this happens. So our 100,000, again, will grow. And here's our 100,000, growing again to 574,000. Always love it when the calculators agree. So here we go, 100,000 growing to 574. Okay, and here's what's happening is each year, now you can see each year the tax paid. So here was $1,800 paid in year 1, and here's and at 6%, what we know is the account should have doubled, right? So there's our $200,000 in 100,000 grew to $200,000, right? At the end of 12 years, okay? And then in 24 years, it doubled again, okay? So there we see how the doubling works. Notice what else, though, is happening. Our first year tax was $1,800. We come out here to year 12, which 12 years after that would be year 36. See how the tax rate's about doubling. And then year 25 here we go. Here it's coming up again. So what we find, this is actually the cumulative. I'm sorry. So this is the cumulative, not year by year. I'll have to take you to details. So guess what happens if your account is doubling because it's compounding, which means the interest you make each year over a period of time is also compounding. And if it's taxable, what else would be compounding? The tax is compounding, right? So if my account is compounding at 6%, so is my tax. Okay. And but what's interesting is, do you think any bank, when someone goes in, or in the past when there were 6% CDs or 9% CDs or whatever, that there was, before you signed up for a CD, that the teller came up or the account manager came up and said, here's a little warning signal just to let you know, are you compounding this? What's your tax bracket? Just to let you know, a little warning sign, like for medication, right? Beware, compounding your interest will compound your tax. It doesn't happen, right? A bank manager, in contrast, once told me, he said that the easiest deposit that we get is the interest we just paid. Which makes sense, right? So there's going to be, is it any wonder that we hear about the magic and the wonder of compound interest and we don't hear about compound tax, right? So, and you can see this here in this sense when we look at the details. See those nice little films here. So here's your annual interest, which means here's your annual 1099, which is here's your income tax that you have to pay. And you can see here it's doubling from $1,800 to $3,600 and again to $7,200 and so forth. Now, that's just the tax that you pay. So we have compound taxable in a compounding situation. Not only do we just have a taxable account, but now we're compounding the tax. And remember, what was it that we have to make sure that if we're paying this tax out over a period of time, what additional costs do we have to add in? The time value of money. So let's put that time value of money in. And we can put 6% here in. And then we can come up here. And now we see that here's our chart now. So here's the tax, the red line, the deep red, and here's that lost opportunity cost. So we had $142,000 in tax paid, but we had as much here as $167,000 in lost opportunity cost on top of that as we go along. So that becomes our issue and our problem. So do we never compound? Nah, there might be times we don't, but we want to continue to compound. But what we want to do is we want to make sure we understand the cost, and is there something better to do? So in this case, what we take a look at, and we'll see how we can manage and do some things. So does that happen in mutual funds too? So we can take a look at this over time. So here is this is actual now instead of hypothetical 6% or whatever. We're going to look at 30 years of market history in a growth portfolio that has about 3/4 of the money exposed to stocks around the world and 1/4 of the money exposed to fixed income, like in bonds and so forth. So we've got $100,000 that's put in 1991. But as we know, when we put money into investments, there's often various fees. So fees were higher in 91 than they are to now, but I just took an average of total fees on everything of about 1.5%. That includes the totality of it. On any money that would have been paid because of income taxes was 35%. Because there's stocks, some of it would have been taxed for capital gains instead. So I'm taking that in there. And then it's how much is subject to income tax. Well, not as much because most of the money's in stocks, so we only have a portion subject to income tax at the higher rate. And some of this, when you own stocks and mutual funds, just like you saw tax deferral, you can also achieve a measure of tax deferral in mutual funds. So if I own 50 stocks in a mutual fund or 5,000 stocks in a mutual fund, and that mutual fund isn't selling the stocks, then there's not going to be capital gains until there's stock sales within the fund itself. So there can be some measure of escaping year by year capital gains. There can be some measure of tax deferral. Okay? So we're saying some of it's subject to income tax, some of it's not getting taxed at all for a while, and then some of it's being taxed on an ongoing capital gains basis year by year, just to try to get some measure. So sometimes when you see advertisements for mutual funds, and we in the industry, they often call them mountain charts because you see how the investment was here, started off, and then you see how it grows over time, right? And there's ups and downs, and that's why it looks like a mountain. There's peaks and valleys, it goes. But you always see in the advertisements that the money, you never see someone, here's our investment, and here's our iceberg chart. This is what happened to your money. They never advertise the iceberg mutual funds, but they only advertise the ones that made money, okay? And then you have it, and it goes up. So we'll see that mountain chart. You'll see something here as we go along. And so there's the mountain chart. Here's 1991, 100,000 invested. And by year 2000, despite all the 2000 crash, the 2008 crash, the 2020 crash, it grew to $1.2 million. Okay? But that was without taking taxes out of it. That was without any subtraction for investment fees. So let's just see the impact of taxes. Now, what we have here is a little bit less money. Okay. Now, if you added up all the taxes, here's $1.2 million that you would have ended up with no tax, and $637,000 because of tax, half the money. Okay. Now, if you added up all the taxes that were paid, you wouldn't come up with $600,000. You might only have come up with $300,000 or $400,000. So why was there a $600,000 loss? Because of the time value of money, right? Now, the little bit of difference here is that when we looked at the previous calculator here on our CD at 6%, we called the tax a out-of-pocket cost. And what we were doing is we were compounding the original account at $100,000 at 6%. And what we didn't do is show the tax coming out of the account. And the reason we didn't, and we calling it an out-of-pocket cost, is because most people don't pull from their accounts to pay the tax that account caused them to pay. They usually came, especially in their working years, because you can imagine someone that had this CD 25 years ago. Actually, 6% was around in the late 90s, and had that 6% account. And maybe they just had inherited $100,000 and they went and said, I just inherited this. Like, go put it in the account at 6%. And then they got around to paying their taxes that year. And they had withholding on their income and everything that they had made and so forth. And then their CPA says, oh, hey, you owe $1,800 in taxes. And they never had that happen before because they never had $100,000 sitting in a 6% CD. So what do you think they'll do to the withholding on their income? They'll probably hold it so that they don't have to pay a tax at the end of the year. Yeah, they'll getting less in their paycheck while their CD's growing. So they're supplementing the cost of the CD. They put in $100,000 in the CD, and then they kept paying more and more and more in tax every year. But they didn't really feel it because, well, if they did it right, and maybe they got an increase in income and actually started over withholding. So this is what happens too: is people will have their investment account. They get their statement at the end of the year, say, hey, I made my 6% interest, awesome. And then a little later, they get the 1099, turn it into their accountant, and another month or two later, the accountant actually says, hey, you get a refund this year because they had over withheld on their income. And they never felt the tax that the CD was costing them. So they just went merrily along, and then they didn't feel the tax. They never did the calculations. They really didn't know how much that happened. The difference is on here what we did is we said, what if they actually pulled the tax from the mutual fund that was growing? And in that case, the lost opportunity cost is felt right within the fund. It wasn't an out-of-pocket, but it was felt within the fund. Does that make sense? Now we pull in investment fees too, and we can see there's another loss of now $446. So the investment fees, again, weren't the full thing, but all of these things cost. So that mountain chart, after you have all the different elements that come in here, will probably not grow. This is not quite as exciting as that mountain, You probably will live after climbing this mountain instead of that one. But so as you go along. So this is what happens. But a lot of times people will say, I ended up with $1.2 million or whatever it was, and they never counted if they didn't pull the tax from here. They don't know how much those taxes actually cost them to get there and have that mountain. They took down another mountain to build this one, and they didn't know this occurred. So what are things that we can do to make that happen, to make it better? Well, this is an example that some of my clients had used for many, many years, and we'll see the benefits. So here's how people often compound it. So we're going to pretend this is a hypothetical account that $400,000 went into, and it has a return rate of 5%. And we're going to assume that there's a time value of money rate of 5%. And in this case, I'm just taking a 40-year-old, okay, that's got some time. They're trying to create money. I know not everybody here on this call is 40 years old one point in time, but if you know people that are 40 years old, or you can say, hey, you got to have this conversation. But this applies to the the understanding, you'll see how all this starts to come in and play. And this is just one strategy, because this is just minimize lifetime taxes 101. So this is, there's other strategies once we know how all these things start to work, that we start to put things together. But a lot of times people in their 40s, because they're making income that needs to be protected, might have $1 million worth of life insurance, and they've chosen term because it only costs them $1,000 a year, while they have an account making 5% on $400,000, and they're making good money, so at least they're in a 35% tax bracket. That's what we're looking at. So as time goes on, what we'll take a look at real quickly is you'll see on the magic of compound interest is happening here. We're taking two scenarios and seeing how do we make it better. So we take the current details, and you can see here's their protection. So they have $1 million of life insurance over this 25 years. They're paid $1,000 a year for, or at the end they paid $25,000. They had their $400,000 of money growing and earning interest, and that grew to $1,354,000. So it tripled over that period of time, more than tripled. And we see that the tax they had to pay as it grew went from $7,000 to $22,000, so it more than tripled too. And so that was the end. So they invested $400,000, it grew to $1,350,000, and along the way they paid $25,000 for insurance premiums, and they paid almost $335,000 in taxes. So that's scenario one. Okay. Now, scenario two says, is there something else that we could do? So in scenario two, what we're going to do is we're going to see, and I'll show you how this would work, is we're saying, well, we've got this $400,000 of assets here. Can we do from like the story, let's see, what was it that had Macy's and Gimbals? Okay, where Macy's or one of them said, no, we don't carry that here, but you might want to go down to Gimbals because they carry it. Okay, I don't know that financial institutions do that. Hey, we don't have that here, but here, take some of our money and go down to this other financial institution with it. I don't think they do that, but we're going to pretend that for a moment. Okay, so we're going to say, hey, instead of compounding the interest every year, what if we take the interest that the $400,000 is making, and let's go put it into what I want to, first of all, we're going to use a life insurance policy just as an example, just because it's tax-free. Okay, so we're going to take $20,000 from a taxable account, and instead of compounding the account, we're going to move the interest, just the interest, into an account that's not going to get taxed. And what we want to do is just see what happens with that over time. So when we come here and we can look at the details just for a second, or the alternate details. Now we're moving $20,000 off the account and putting it into the tax favored account. Now what you'll notice is if you take that out at the beginning of every year, you're taking out a little bit more than the interest. And so what's happening is the account over time. Now, how did that happen? What do we do here? Yes. Okay. So now we're doing that. Now what you'll notice is that the income tax each year isn't going up. It's not compounding anymore, is it? No, because we're taking out the interest, we're not allowing the interest to compound. Instead, we move the interest to a tax favored account, so it's not compounding. So instead of nearly $334,000 in tax, only $158,000 in tax was paid. You saved almost half the tax. And if the choice of a tax favored place was the life insurance, you also then didn't have to pay the term insurance. So they saved the $25,000 there. So there's a lot less cost that went out. So in essence, if you took a look at this in a more graphic standpoint, what we see here in the current is here we have our $400,000, and the interest is just compounding. And then the cash flow is $1,000 out of pocket is going to pay for the insurance. Then what happens is, because of the $20,000 of interest, 35% has to be sent to the IRS. Check for that has to go out. So there's $7,000 of annual income tax that first year. Now we move forward. And since we have a 6% account, let's move forward like to year 53. So we see one more year. Here we go. 12 years later. And now we see, now the tax has grown. The account's growing nicely. And as we got to the end, we had $1,354,000 in the account. Now, I'm not sure what the insurance contract will gain because we're using a 5% hypothetical account and we're using today's interest rates on an insurance contract, which are lower. So I don't know what that's going to look like. But if we take a look here, just look at what's been saved as far as taxes go. So now we're letting the 5% account send the interest over to an insurance company and deposit it there so that it's a tax favored place. So what happens now is now there's no out-of-pocket cost, no term insurance premium, and there's still tax here, like we talked about. But instead of the tax growing, now the tax is being saved. So that first year, we save a little bit of tax, $350 in tax, and we save the insurance premium. But if we come here, it's 12 years later, now we're saving between the insurance premium and the taxes, we're saving almost $8,000. That's now staying on our balance sheet. It's cost savings. Over time, so far, that's grown to be $80,000. By the time we come out 25 years, we still have money in the original account. We have money in the insurance contract, and we have money here in cost savings. So we have more money in a 5% account. And we happen to have an insurance policy that wasn't term that actually stays on the books in that case that has other purposes and use. But this is just saying one strategy, whatever that account. That money, that 5%, if the person was working, had earned income, that $20,000 could have found its way into many, many things. It could have found its way partially into Roth IRAs, for example. It could have found its way into an insurance contract. It could have found its way into municipal bonds. A number of different elements that are available if a person chose to do so. It could have found its way into an investment property, real estate. So many choices once you take a look at and say, I don't have to compound my money. I can say, here's interest that it's making. What's the highest and best use of that interest, taking into consideration taxes and other elements such as we've discussed today. So we take a look at, again, taxes. We don't know where they're going to be in the future, but certainly we want to make sure that what we're doing is considering that tax rates could be higher in the future and putting ourselves in a position, if that occurs, that not all our money is going to be exposed to tax in that situation. We come along and take a look at, there's different forms of way things are. Just consider these like different chess pieces on a chessboard. They all have their place and have not just how they move, but how do they move together and what can we do. That it's important that we take into consideration that we are also just doing compound interest, that we're not just compounding our money without thinking about it and thinking about what's happening from a tax standpoint with it, and always considering the time value of money. that this is something that we want to consider when we're comparing anything and really looking at how things work over time, and then strategies that can say, what's the highest and best use of every dollar that's being considered and being produced, so that we end up in the best position in total in our financial world. All right. Well, I appreciate this opportunity to talk now. Just real briefly, I'm going to go and hit where this comes in, because what it is isn't just all of these elements here together, but it's also all of these are elements of larger piece and understanding as far as what we are looking to try to create here. So let me just put this here. I got to switch what I'm doing here for a moment and share this with you here. Just wrap it, then we'll be able to wrap this up. Oops. Okay, just a moment. I'm using some new software for presentation today, and I hope that it's helpful here to you. Okay. All right. This works okay. All right. So we have our 10 principles of optimal financial wellness. And a number of these principles come to play when we're talking about taxes and these strategies. The first is, again, we're always trying to look at optimal. So we look at all of these different elements that are available and having our tax situation in the best situation that we can based on our individual circumstances is part of imagining optimal. How do we have the least overall erosion of what we have due to taxes? So we're always trying to think what's the best position we can put ourselves in based on what we have available and where we are now. What can that do? The next piece that we have to take a look at is we're trying to look at synergy. And so as you just saw there, one piece of what we have, yeah. Oh, did I not do something here? Okay. Okay. You see it? You see that? There you go. All right. Awesome. Okay. So what we're, now do you see the next one? Okay. All right. So very good. So synergy, we're looking at in the sense that what we want to make sure is not everything has this, as we talked about, has the same tax situation. Some things are tax-free, some things are tax-deferred, some things are taxable, and each has other characteristics along with it outside of just the tax situation. Some are more liquid than others. Others are more risky than others, for example. So, but what we're looked at is just from a simple tax standpoint, just that by itself, we're saying, hey, can we combine perhaps a taxable situation with something else that has a more tax-favored situation? And can we, over time, maybe move money from one to the other that will reduce our overall taxes in time? But we have to think synergistically, not just what one type of financial instrument can do by itself. What can it do in conjunction with others? The other is we have to assemble frameworks. So just as you saw different calculators and you saw at the end cash flow design, what we have to do is we have to be able to see the whole picture. We have to see very easily, what do you have? How is it laid out? And because without that visual, without those frameworks, we won't be able to design as something as optimal, and we really can't do the synergy as we look for. We're always looking to see how do we build savings on a greater basis, and we'll be in a much better position to have greater savings than when we're following an optimal course from a tax standpoint. Just like we saw compound interest could mean I'm growing money in my account, but because I'm having to pay tax, I may be that I'm paying out of my income means now I don't have that money to put into something else. So my income is being hurt, and I'm hampered and limited on my building savings if I'm not following a good tax strategy. That's helping me there. We want to look for mitigations. What are ways in which we can reduce loss over time to taxes and minimize that, not just looking at it today, but what are we building today that's going to have even a higher value and benefit down the road. And then we're looking for balance too. So again, because we don't want to have all our money in tax deferral, because if it's all tax deferred and then tax rates go up, we might have shot ourselves in the foot. So we've got to make sure we have balance, since we don't know what the future is going to hold. It's going to remain fundamentally unpredictable in personal economics, and the tax laws are going to be changing all the time. So we want to have a balanced situation so that we can move in a good way no matter what happens to us. And then we're trying to create efficiencies. How do we get our money working with less cost and more productivity as we go along, so that ultimately we're creating, in an unpredictable world, we're creating more optionality, more ability to move and respond in a way that minimizes loss and captures opportunity and gain. So those are the principles then that guide. We're always trying to do that. How does that work from a tax standpoint? And that's what we wanted to illustrate here for you today. So I hope you found that that was accomplished for you.